Guys, let's talk about the power of leverage. You can power your money and leverage into more properties, which creates more cash flow and ultimately more wealth for you. What's up, you guys? So I wanted to make this video today about the power of leverage and investing in real estate. So this is one of the first lessons I ever learned about investing in real estate, and I just absolutely fell in love with this idea. If you don't know anything about me, my name's Kyle Claus. I'm an actor, entrepreneur. I run a multi-million-dollar real estate company. We have over 50 agents in multiple states. We are growing rapidly. I'm an investor in real estate. I have been for years. And while there's nuances of everything, I'm just making general cases here, but I know it does work firsthand because I've adopted this mentality and have done this myself. So let's get right into it. Guys, first off, let's talk about the power of leverage. Leverage is taking some portion of your money as a down payment and leveraging it for more, or being able to apply for a loan or a mortgage and leveraging more of your money. So let's say you have 200K to invest. Make these figures out. A lot of people don't have 200K, but these figures still work. It's still the same principle. So you got 200K to invest, and you put this in the stock market because you heard stocks are a good investment, stocks are a safe investment, whatever. Say you put it in the stock market as a whole. I'm not talking about buying individual stocks. You're just taking it, you're putting in the SPY, the S&P 500, and that grows at an annual return, maybe say 10% year over year average. So you take that 200K and you put it into stocks, and that grows at 10% annual return. Now you got 220K at the end of the year, making it a 20K profit at the end of year one in the asset that you hold. Now, say you take that 200K and you purchase a property, you got 20, 25, 30% down payments, and you find a property worth 800,000, a lot of places in around the New York City area, LA, California, they are, you're going to find a $800,000 2-3 family. If you want to make an investment, you're going to put 200K down. Now, say that grows at an annual return of 10% also. Now, at the end of year one, that's worth 880K, and you have made 80K appreciation. And let's hope that you found something that, you could cash flow about $1,000 over the mortgage a month. Now you got this 200K and $800,000 property, 880 at the end of the year it's worth if you sold it. That's saying the market didn't go down, of course, but you got 80K of appreciation and you got 12K in cash flow. That's assuming that the tenants are paying on time and you found something that's paying $1,000 over the mortgage in rent. So now that's a pretty good option. I mean, that's a lot more than the 20K you're going to get in the stock market for appreciating at the same rate. Now let's say you take that 200K and you find 4 different properties that are 200K each, 250K. There are places in America, yes, I know, not around New York so much or California, but I know for a fact that, say, you got to go maybe a little bit outside. If you're willing to do this, you can find a property manager locally where you want to go. But maybe you are from an area for instance, I'm from Pennsylvania originally. I know there are 2-3 families that you can buy for $250,000. There used to be 5-6 years ago, get them for $150,000. I know personally because I did it, and put 30 grand down or 40 grand total with closing costs. But say you are getting a place that's 200K, you're buying 4 of them, and you're putting 50 grand down each, your whole 200K of investment. Now you have 4 properties at 200K each, and they appreciate 10%. So you still got 800K worth of real estate. That goes to 880K, and that is 80K of appreciation. But now you might find that each of these properties will each create $1,000 over the mortgage. So now you got 12,000 at the end of year one in each of these, and you're seeing a 48K cash flow profit. So now you got 200K, you buy 4 200K properties at 50K each, you got 12K each coming in cash flow, 880K appreciation. So you got the 80K of appreciation in the asset, and you got the 48K of cash flow. So now out of these 3 options, you can see what's better. Again, there's nuances. Yes, you're gonna have more tenant problems. You're probably gonna have at least 8 sets of tenants in this situation because they're gonna be multifamilies in each of these. instead of one set of tenant or maybe two sets of tenants. But the below, if you get a vacancy here, is going to be much greater than if the below if you get a vacancy here. If you get one of these, you're just a little bit less. You get two of them, you're a little bit less. Now, watch the areas that you're at. You don't want to get into like area that the tenants aren't going to pay the rent. The point being is that you can power your money and leverage into more properties, which creates more cash flow and then ultimately more wealth for you. You know, that's my 2 cents for, you know, real estate investing and leverage. You might want to consolidate it. You might be okay with getting it in a better area and hoping for the appreciation. That's all good. I'm a big believer in diversifying within your diversifications. So like real estate, you're diversifying from stocks, but also diversification within real estate. There's different plays. Maybe you have cash flow plays here and you have appreciation plays here. Diversification, diversification, diversification. That's what I got for real estate investing. Hope this helps a little bit. Let me know if you have any questions, comment below. And if you want to see me make a video on something else, I'd be glad to do it. Just reach out. If you haven't done yet, please like this video. It helps with the YouTube algorithm. That's all I ask. Guys, thanks so much for tuning in. And as always, see you later. Peace.